Picture this. You're 64. You've worked your whole life, paid taxes, raised your kids, done everything right, or at least everything you were told was right. You sit down one quiet Sunday morning with a coffee in your hand. You open your super account on your phone and you stare at the number. And the number doesn't match the life you planned. Not even close. You always figured you'd hit retirement and just switch off, like a light. Work one day, free the next. But now you're doing the math, properly, maybe for the first time, and something doesn't add up. Here's the thing that keeps me up at night thinking about this. Most Australians won't realize there's a problem until they're already in it. Not because they're careless, not because they're bad with money, but because nobody sat them down and showed them the real numbers. The honest ones. The ones that include inflation, healthcare costs, and what a comfortable life in Australia actually costs per week. And right now, in 2026, there are new rules, brand new laws that just passed Parliament that are going to change how superannuation works for millions of Australians. Rules that financial advisors are scrambling to plan around. Rules that most people have never even heard of. So today, on RetireScope AU, we're going to do something different. We're going to look at the retirement problem most Australians are quietly sleepwalking into. And more importantly, we're going to talk about what you can actually do about it. Stay with me, because the next 10 minutes might genuinely change how you think about the next 10 years. Let me start with something that I think is one of the biggest myths in Australian personal finance. The idea that you need $1 million to retire. You've heard it. Everyone's heard it. It's thrown around at barbecues, in financial planning brochures, on YouTube. $1 million and you're done. Here's the truth. That number is not wrong. It's just incomplete. And the difference between not wrong and complete can cost you a decade. Let me show you what I mean. According to ASFA, the Association of Superannuation Funds of Australia, as of late 2025, a single homeowner needs roughly $54,000 per year to live a comfortable retirement. Not luxury, comfortable. That means occasional travel, private health cover, and the ability to go out for dinner without doing mental gymnastics about whether you can afford the main course. Now, here's where it gets interesting. If you've got $1 million in super, and you use the standard 4% safe withdrawal rate, which is what most retirement calculators are built on, you're pulling out $40,000 a year. That's $14,000 short of comfortable. Every single year. Sit with that for a second. You spent decades chasing the $1 million number. You skipped things, you sacrificed, and the finish line you were running toward doesn't even cover your bills. And that's before we factor in the thing most calculators quietly hide in the footnotes: inflation. Stay right there, because when I show you what inflation actually does to your retirement savings over 20 years, it's going to make you see your super balance in a completely different way. Think about what groceries cost 5 years ago. Think about your electricity bill. Think about what it costs to fill up your car. Now imagine that same creep happening every single year of your retirement for 25 years. Because here's the reality. If you're 65 when you retire, statistically, in Australia, you're looking at living until 85, maybe 87. That's 2.5 decades of your money needing to keep up with rising prices. And it doesn't. Not automatically. At a modest 2.5% inflation rate, which, if you've been watching prices lately, feels almost optimistic, the $54,000 that covers a comfortable life today becomes closer to $100,000 in today's dollars by the time you're 85. So the real question, the honest question, isn't, how do I get to $1 million? The real question is, how much do I need so that I don't run out of money before I run out of life? And that number, for a single Australian homeowner, is not a million. It's closer to 1.3 to 1.5 million, depending on your lifestyle. If you rent rather than own, add another 2 to 300,000 on top of that. Now, I'm not saying this to scare you. I'm saying it because knowing the honest number is the only way to actually plan for it. Think about it like GPS navigation. You can put in a destination and it'll show you the route. But if the destination address is wrong by 3 streets, you end up somewhere completely different and wondering what happened. The right destination matters more than the speed you're traveling at. But here's where things get really interesting and a bit confronting, because the federal government just passed a new law that's already changing the rules for Australians with larger super balances, and it kicked in on the 1st of July, 2026. So this is something that I think deserves its own honest conversation, because there's been a lot of noise around it and not a lot of clarity. It's called Division 296. The legislation passed Parliament in March 2026, and it took effect on the 1st of July 2026, which means it's happening right now, this financial year. Here's what it is in plain English. If your total superannuation balance across all your funds combined exceeds $3 million, you're now subject to an additional tax on the earnings from the portion above that threshold. The current super earnings tax is 15% in the accumulation phase. Division 296 adds another 15% on top of that, bringing the effective rate to 30% for balances between 3 million and 10 million. If your balance is above 10 million, that additional tax goes up to 25%. Now, most Australians will hear $3 million and think, that's not me. I'm fine. And right now, that's probably true. The government's own estimates suggest this directly affects a relatively small proportion of the population, those with the largest super balances. But here's the thing I want you to pay attention to. That $3 million threshold is not indexed. It won't move with inflation, which means that over time, as super balances grow, as the market compounds, and as cost of living increases push contribution levels higher, more and more Australians will slowly drift toward that 3 million mark. Not because they're wealthy, because time and compounding are doing what they're designed to do. Think of it like bracket creep on income tax, except for your retirement savings. I know a bloke works as a site manager in construction, lives modestly, has been contributing the maximum concessional contributions for years. His super balance is sitting around 1.8 million right now. He's in his early 50s. He's never thought of himself as someone who'd be touched by a super tax for the wealthy. But at his current trajectory, he could cross 3 million before he retires. Nobody told him this was coming. And that's exactly the kind of thing RetireScope AU exists to talk about. Not to create panic, but to make sure you're not blindsided by something that was always on its way. So what do you actually do about this? And more importantly, what should someone with a much smaller balance, say 200,000 or 400,000, be thinking about right now? Because the solution isn't the same for everyone. That's coming up. But first, if this is the kind of conversation that's actually helping you think differently about retirement, hit the like button and subscribe to RetireScope AU. We put out videos like this every week, breaking down the real numbers behind Australian retirement planning without the jargon and without the sales pitch. Let me share something that stopped me in my tracks when I first read it. The average Australian man retires with around $400,000 to $420,000 in super. The average Australian woman, around $350,000 to $360,000. Remember the comfortable retirement number we talked about? The one that requires 1.3 to 1.5 million, we're not even at half of that. On average, that gap between what most Australians have and what a comfortable retirement actually costs is not a small gap. It's not something you can fix by cutting out a few takeaway coffees. It's a structural gap, one that's been building quietly in the background while people were busy living their lives. And the thing that makes it worse is this. Most people don't realize the gap exists until they're close enough to retirement that the options have already narrowed. At 55, you still have options. You can increase contributions. You can restructure. You can make real decisions. At 63, you're mostly just hoping the market holds up. I want to be honest with you here because I think this is important. I'm not a licensed financial advisor, and nothing in this video is personalized financial advice. What I am is someone who cares deeply about Australians having this conversation, because most people aren't having it. And the cost of not having it is measured in years of freedom you don't get back. Because the solution to a retirement gap isn't the same for a 29-year-old as it is for a 52-year-old. And one of the smartest things I've ever heard about retirement planning completely changed how I thought about the finish line. Let me share it with you. Here's a reframe I want to offer you. Most people think about retirement like a mountain. There's a peak, some enormous, terrifying number, and you have to climb the whole thing before any of it means anything. But retirement is actually a staircase. Every bill you can replace with investment income is one step, and every step you close gives you a little more freedom, a little more breathing room, even before you reach the top. Let me make this real. Say you're in your 30s or 40s and your monthly expenses look something like this: rent or mortgage repayments, car costs, groceries, utilities, health insurance, and the occasional meal out. Let's say that adds up to about $4,500 a month, $54,000 a year. Now here's a question most people never ask. Which of those bills is your investment income already paying for? If you've got $80,000 in super right now, earning at a long-term average of around 7%, that's roughly $5,600 a year in returns. That's your grocery bill. That's your phone plan and your electricity combined. Already covered. Already working for you. You might not be able to access it yet, but the point isn't access. The point is trajectory. Every extra dollar you contribute closes another door. Not the big final door, just the next one. The car payment door, the utility door, the health insurance door. And one door at a time, your dependence on your salary gets smaller. That's freedom in the making. Not the big, dramatic retirement day freedom. The quiet, compounding, nobody can see it kind that builds for years before it becomes obvious. I find this framing genuinely more motivating than staring at a massive number that feels impossible. Because a staircase has a next step. A mountain just has a summit. So let's bring this together. The retirement problem most Australians don't realize until it's too late isn't a super problem. It isn't an investment problem. It's an information problem. The real costs are higher than the number everyone's been sold. Inflation is real, and it compounds over decades. New laws like Division 296 are already changing the landscape. And even if they don't affect you directly today, the trajectory matters. Consistency beats intensity, and your personal number matters more than any benchmark. If you want to keep having this conversation, if you want more videos that break down the real numbers behind Australian retirement without the fluff, Subscribe to RetireScope AU. Every week, we go deeper on the topics that matter most to Australians who are serious about building a retirement they can actually live on. Drop a comment below and tell me, what's the retirement number you've always had in your head? And do you actually think it's realistic? I genuinely read every comment, and I want to know where people are at with this. And if this video made you think differently, even slightly, share it with someone you care about. Thanks for being here. I'll see you in the next one.